So let's talk about some tax efficiency planning cracks that we see. One of the things that I see quite a bit of nowadays is people don't know how to manage after tax accounts. We call them individual accounts or brokerage accounts. And a lot of times, these accounts, they're taxed differently. You have capital gains that you have to worry about on those, and realizing gains and realizing losses. And when someone comes in and we're meeting with them and I'm doing a review of the tax return, which we do with every single client that walks in the door, I see where they are writing off a loss in their brokerage account. And that always puzzles me a little bit, because that's probably not the best place to do that, or to handle the taxes, or the best way to go about doing that. And a lot of times when we see they're writing off, what is it, like $3,000 a year is the limit that you can do on that, on some big loss they took in an investment that they made, they're not able to really, maximize that loss, so to speak, whereas they had maybe some really highly appreciated position that they had really done well in that brokerage account. And they could have offset that loss by selling some of that, realizing some gain in that really highly appreciated position that they want to kind of get out of anyway. And they just don't understand that. And so that is something that we teach folks that work with us all the time. We actually have a tax loss harvesting team that works on those accounts with us to make sure that you handle those positions correctly, and that when you realize gains and realize losses, that you're doing it in the most tax efficient way possible, right? So we see that quite a bit. The other thing that we would see is dividends.
Yeah.
Talk about that.
I was going to say, this is the one that, when you've got after-tax accounts, guys, we see this so often. People love to open up a brokerage account. They've got their 401k and they're like, I want to do some investing on the side, which is awesome. Again, we're talking about that. You should absolutely do that. But what you don't want to do is start buying all these dividend funds and income funds, because, guys, what's happening is, there's two types of tax consequences in an after-tax account. You either have dividends and interest, or you have capital gains. If you're just holding a stock, you're not having to pay taxes throughout the year until you sell it, right? So that's capital gains. That's what we want to see in after-tax accounts. We don't want to see these dividends and interest. A lot of people, you're earning 4 or 5% interest on this account. You're probably just reinvesting it, which is great. It's good to earn that, but you're paying taxes on all that stuff. You're paying ordinary income taxes, unless they're qualified dividends, which they're probably not. So what you really want to avoid stacking up a bunch of these dividend and interest funds in these after-tax accounts, because you're probably not using it to fund any lifestyle. It's probably just being reinvested. And you're paying all these taxes along the way that's going into your ordinary income.
Yeah. What's the saying? The surest way to build wealth is to avoid paying taxes on money you're not using, right?
That's a good one. That's a good one, Stewart.
Yeah. That's something that we help folks with, is managing those capital gains and really helping you to make sure that you don't get yourself into a unnecessary taxable event